Hello everyone, welcome to another episode of Market Bites. Just the two of us today. If you're on YouTube, you already know that. And if you are on YouTube, like, share, subscribe, all of that is always appreciated. I'm joined by Neža. Neža, how are you?
Hi Sam, I'm doing well, thank you. Yes, we missed Josh today. He is in Abu Dhabi having fun on the conference. I hope so. He will tell us more about it next week, and we definitely miss him. How are you, Sam?
Yeah, we do. Big shout out to Josh. He made his in-person Bloomberg debut, and it was great. He handled himself very well. So Josh, if you are listening to this or watching it, congratulations. We're all proud of you over here on the Market Bites team. But yeah, I'm good. We're going to discuss a few little bits and pieces today. We'll talk about the tariff situation. We'll talk about the market reaction. We also had US CPI yesterday, so we'll talk about that, and then we'll ask the question, what else could happen? What else should we be focusing on right now? I don't know about where you are, Neža, and there's a reason I'm asking this question because it will lead to the question I'm going to ask you, but has the weather been nice?
Yeah, it's been better than a few weeks ago, definitely.
Good. Well, on Saturday, and the reason I asked is, it was a lovely day, and I'd organised to play some golf. Went and played golf with a few of my friends, but we were up early. It was a long drive, so I don't know. Woke up at like 6:45. Went and played golf. Got home about 3:30, 4:45 p.m. And I was supposed to meet my friends at 4 in a place near Hampton Court, which some people will know where that is. Basically, Henry VIII, who was a former King of England, lived there. Anyway, a little bit further on than there is where I was going to meet them. So I had to cycle to miss some of the traffic, and then that tired me out as well. So by this point, I'm quite tired, and I eventually go meet my friends. An hour late I was. Anyway, we had a few drinks and a good time, a little bit of a party, and by the end of the night, I'm knackered. I'm so tired, and I get in an Uber home, and obviously, I fall asleep in the Uber, and I forget to take my phone.
No.
So the whole of Sunday, I'm without a phone. I'm messaging my mum on WhatsApp, which is on my laptop, to be like, look, if you hear from the keep ringing the Uber driver and hopefully they'll answer. Anyway, they eventually did, but what I was doing, I just had to sit on my laptop the whole day, and then I started to see these headlines come through about a trade deal between the US and China. I was like, hang on, my luck is turning here. Markets are going to be positive, and then 20 minutes later, I got a message from my mum being like, the Uber driver's going to drop your phone off to my house at 9 p.m. And I was like, this is perfect. And it kind of reminded me of how 2025 has gone. It's been like promising and then negative and then promising, and we're back to where we are. So what is the latest on the tariff situation, the trade deals? Like I said, there's a few headlines floating about on Sunday, and it has been a positive reaction since.
Yeah, that's the major topic this week. But by the way, I'm really happy for you that some positive sentiment after Arsenal last week.
Yeah. We don't
Sorry
want to talk
for
about
that. But if we talk about tariffs, yeah, I already mentioned over the weekend, US and China pulled off some surprise turn in their ongoing trade war, which was finally some relief for the market, because after months of these rising tariffs and increasing tensions, both sides agreed to slash duties significantly. And of course, markets absolutely love that, because on Monday, US announced that they would reduce their tariffs on China goods from 145%, which is incredible number, down to 30%. And China decided to cut their tariffs on US imports from 125% to 10%. And that is a dramatic shift. It is only in place for next 90 days. So both sides will continue with negotiations. And even though it is temporary, market needed this relief, and the tone has definitely shifted. Both countries are open for negotiations. So we will see what will happen in the next 90 days. And result so far was obviously a massive a relief rally, we could say, because on Monday we saw S&P 500 jumped over 3%, NASDAQ soared more than 4%, and investors have been pricing in prolonged trade tension, and suddenly this pressure finally lifted. But of course, we cannot celebrate completely yet because there is still this 90 day window, and that buys some more time on what could happen next with the tariffs. Besides that, not all tariffs were lifted because Trump's 10% tariff on all imports is still in place. And there is still this special tariff on small packages from China. So, companies like Shein and Temu are rushing in to send as many goods as possible to US warehouses in this 90-day window. But yeah, markets finally caught some breath, and hopefully they will continue with negotiations and we will see some more relief even in following days.
Yeah, it's been a crazy couple of months, really. I think a month ago, the S&P 500 was 1,000 points down. Goldman Sachs were talking about the market going to 4,000. It's now nearly at 6,000. So it's been an incredible turnaround. I mean, there'll be some people that think Trump bottled it. There'll be some people that think he did a massive U-turn. There'll be some people saying it's the art of a deal and he's absolutely smashed it. He went high, came low, and everyone's happy now. There was a lot of confusion. I think there has to be said. Markets hate the uncertainty, don't they? Sort of the VIX did. Obviously, the VIX considerably lower now. I'm with you, though. When it was like, it's a 90-day thing, that leaves a little bit of potential worry, doesn't it? It leaves the door open for a Trump comment at some point to be like, Trump need to get their act together, or at the end of 90 days, it's going to 145% again. And that, I imagine there's going to be a few bumps in the road before we get to that point. I mean, that's just how the markets work, don't they? You think we're out of the woodwork and then suddenly you get a negative comment. It really has been I guess, a tough year for holding short to medium term positions. And what I mean by that is you could get in a really nice trade, really nice entry. Technically, it makes sense, or fundamentally, it makes sense. And then a comment just randomly comes out that you can't plan for, and it automatically goes against you, or you get a little bit lucky. So it's been a tough year for those that have been involved in the markets and have found it tough. You're not alone. For those people that have rode the storm, that have stayed in their positions, that have even bought the dip when the dip did happen, you're sitting pretty happy right now.
Definitely. But especially during these times, is really hard to time the market because we can't time when Trump will tweet something or he won't, or what will the tweet say. And all of these shifts that we are seeing are definitely also they have an impact of his tweets somehow.
Yeah.
So if we talk about different assets, different stocks, which are the ones that caught your eye in the last 3 days?
Yeah, well, I mean, naturally, the first thing I look at on a Sunday evening after some good comments is the equity markets, and to see the NASDAQ and the S&P up considerably, and then for them to finish up 4% for the NASDAQ, 3 and a bit for the S&P, those are the main ones that catch my eye. But I thought it was interesting what gold did. Gold came under a little bit of pressure, which you would expect. It's had a really, really good year, really good, period before this year as well, where it's just been higher on geopolitical risk, trade tariff risk, inflation risk, lack of rate cuts, and all of these kind of things. It's helped push it higher. You get a removal of some of those worries, it's got to come lower, and it did. The question is now, does it actually mark a short-term to medium-term top for gold, and we go considerably lower from here? I'm not sure, but I'll be keeping a close watch on that. I thought it was interesting, the reaction of oil. In theory, if oil's to come under considerable pressure, one of the reasons it could be, apart from supply and demand, OPEC, all of that kind of stuff, is a recession worry. And that has now moved higher. It's above that sort of magic $60 at the moment. The reason I say magic $60 is it's just an incredibly important technical level where below there, it's got room to really go lower. Above, it feels it's a little bit more secure. We're now above that. I'd also been keeping an eye on copper as well, another sort of recession indicator. That looks like it's primed for a move to the upside. I also think, just looking at the S&P 500 from the first sort of couple of days of trading, it's interesting. Nvidia is up 14% this week, Tesla 21%, Amazon 14%, Apple 7%, Meta 11%. Google's actually down a little bit, but there are other reasons for that. So the Magnificent Seven have stuck out for me as well. One stock, Neža, I know you wanted to talk about this, that's been remarkable, is United Health.
Yeah, that's right. I'm something that caught my eye in the past few days are two stocks actually. First is Hims and Hers Health, and the other one is United Health Group. And both of them are on completely different sides of sentiment spectrum, we could say, because if we talk about United Health first, we saw the stock dropping by 18% just yesterday, so on Tuesday, and I think it hit 4-year low. We saw some turbulence around this stock in the past few months, so this is not the first bump they hit on the road. But what was the reason for drop yesterday? This drop was actually a result of a perfect storm of bad news, we could say. Because first, we saw this news about their CEO resigning. He cited his personal reasons for that. But when we see a CEO resignation just few weeks after a massive guidance cut and historic earnings miss, well, that could be a red flag for the market, of course. And the company also pulled its 2025 outlook entirely, which Wall Street hates to see. So basically, it is a mess. The stock is down almost 40% year to date, and trust in management has been badly shaken. So this is one of the stocks that really moved opposite to the market yesterday. But the other one that it is surging at the moment, it's Hims or Hims and Hers Health. I don't know if you guys already heard about the stock. It's all around the X platform.
It is.
It was up 16% yesterday, and it is just continuing its strong multi-day rally. Reasons behind this enthusiasm. First, the company dropped an impressive first quarter earnings report. They more than doubled their revenue, and market obviously loved the news. Besides that, it was more than just the numbers. They also hiked full year guidance, but perhaps the real kicker for this rally was the announcement that they are partnering up with Novo Nordisk. They will start promoting their weight loss drug Wegovy on their telehealth platform. And this is a massive credibility boost for the company, because Hims is no longer seen just like a company that is promoting and selling hair loss supplements and things like that. It is really stepping into the pharma game, and this is reflected in their recent stock performance.
Do you know what I would say? And you mentioned there about Hims and Hers, that all over X, and it is. Mm-hmm. One of the things I've learned over the 11 years that I've been in markets is generally, if there is a stock that's talked about a lot on social media in this sort of cult fashion that Hims and Hers is, it's usually a bad thing. This time it's not. They've got it absolutely right, and they've been talking about it for a considerable amount of time. And the stock performance is fully justified. And you mentioned some of the new fundamental drivers there, which makes sense. A double-digit return yesterday. Fair play to the Hims and Hers community. My reason for not getting involved has saved me a lot in the past with other stocks. This time just happens to be the one where I feel like I've missed out. And you know what? It is what it is, but incredible. Also, I think it's worth noting some of the crypto performances. Bitcoin didn't really do anything. It really didn't to these headlines. And I thought that was quite interesting. On the other hand, it's been so resilient recently. and has not really done that much when other markets have tanked. So therefore, okay, fine, it's kind of oblivious to what's going on. Ethereum, on the other hand, has had a few double-digit returns, really strong performances. We had an analyst meeting, didn't we, last week, and I talked about how Ethereum kind of looked like it might be starting to bottom out, and it did, but went up way quicker than I thought it would do. So I can't really take too much credit for that, but I will anyway. But yeah, interesting time in markets as always.
Yeah, it's hard to react, even though you think, yeah, it is getting there. There might be a bottom, but if you don't react, you get nothing from it.
Yeah.
And you can just say, yeah, I was right, but I didn't do a thing about it. And also with hymns, there was a hype around the stock before, and it surged before and it dropped again, and now it's surging again. So there might be more opportunities in the future. You never know what will happen next. Because also just one bad news, on the other hand, we can see a stock dropping massively.
Yeah.
So there is nothing sure about what will happen next. And there are also news from macro. If it is not just about specific stocks that we want to talk today, there was a US CPI release. So can you tell us more about what came out and how did the market react to the news?
Yeah, I mean, as you said, CPI yesterday, always in that sort of 1:30 p.m. slot for those in the UK or for those elsewhere, an hour before the cash open. So the market yesterday morning, after an incredibly good Monday, was not really doing too much. It was kind of just waiting for the main event. The main event happened and CPI was cooler. So it was lower than expected, which in theory is exactly what you would want to see if you're bullish equities, if you want to be in a risk on mindset. And there were slight gains. I mean, it was a little bit lower. It wasn't a crazy amount, but we had a really, really good Monday. And I wonder if we didn't have a great Monday, whether actually we would have rallied more off the inflation news yesterday.
Okay.
And I think that probably would have been the case. The report, why was it lower? Primarily due to lower oil prices, which we have seen. There's also the largest drop in grocery prices since 2020. However, there are still a few underlying pressures that do remain. Housing costs, they're staying elevated at the moment, and core services, which exclude shelter, continue to rise, which are areas that the Fed are monitoring closely. And I tweeted out yesterday, Jerome, get those rates down in July, and someone replied, no, absolutely not. And we had a little friendly debate about it. And by the way, I don't think he is going to lower rates, but I also said at the same time, you just know Donald Trump will be tweeting about, or whatever you call, posting on Truth Social about this later on. And that, Trump has now called Jerome Powell Mr. Too Late. And that is the argument for getting rates lower, is that we can see the direction of things are going and what we think is going to happen. Get rates down. Whereas the Fed maybe historically have acted too late on everything, whether that's raising interest rates or lowering interest rates. But they are in a position where they can't really win. And, trying to get ahead of the curve, if you haven't necessarily got all the information you want or need, is a risk as well. So, yeah, I don't know. I'd say short term, it's a benefit to see inflation down, and risk assets should benefit from that, especially equities and interest rate sensitive sectors like real estate. And there was a slight dovish tweak on expected rate cuts, but at the same time, you're seeing positive tariffs and trade deals, and that lowers the recession risk. And if that comes down, then there's no need for emergency rate cuts, lower interest rate cuts. So it's a catch-22. But let me read out to you the post from Donald Trump, because of course the report probably suggested the Fed could remain cautious, no need to rush into those rate cuts or hikes or whatever. But this is the post from Donald Trump. No inflation, and prices of gasoline, energy, groceries, and practically everything else are down. 3 exclamation marks. The Fed, all in capital letters, which I don't like, must lower the rate like Europe and China have done. What is wrong with too late, pal? not fair to America, which is ready to blossom. Just let it happen. It will be a beautiful thing. What's your thought on that?
I was just waiting for him to tweet something about it because I knew that he will have lots to say about it, and I bet that Powell and the Fed will feel so much pressure from his side in the following months, especially if we see another more positive report like this one in the future. I think that Fed will be under a lot of pressure, even though maybe the numbers, especially the core data, isn't there yet completely. I think that there will be under pressure to cut the rates. But as I always say, I think that for now, Fed is doing a fabulous job so far. We can't say they did anything wrong yet. And I think that their stance is, they were on time basically for now, and the market is really unpredictable, and it's good for them to have this chance to lower the rates if there would be a absolutely need to do that. So yeah, I'm wondering what will the next Donald Trump move be.
Yeah. Do you know what? I think that's the point I most agree with, is that there's still uncertainty. Now,
Yeah.
when there's uncertainty, why not keep your powder dry? Because if something bad does happen, you've got more room to work with. I think that's the key thing. And whilst, if it was probably up to me, and it's not, I would really consider getting rates down. That argument you just mentioned there is probably the reason why a lot of people would suggest the other thing, to keep your powder dry. I think that's right. We did a podcast earlier in the year, and I think there was a report that the FT did where they were talking about retail investors versus institutional investors, or institutional clients, and it was asking who's going to win, whether retail investors that were buying at insane speed after that dip were right, or for those hedge funds and big time players that were sitting on the sidelines that were unwinding positions, whether they were going to be right. Fast forward to now, the market's up considerably. So retail must be pretty happy, right?
Yeah. I remember that conversation perfectly. We talked about how retail was considered a dump money a few years back. And now we see how they think differently from institutional money, and who's going to win, basically. And for now, as you say, yeah, retail is winning this competition, basically, because we see that they benefited from buying the dip in the past few months because the markets are up. And meanwhile, this institutional money was more cautious. They were talking about potential recession in the second half of the year, and they were sitting in their big cash piles, but retail was buying in. Maybe retail got more of this long-term perspective now than they did a few years back. They decided to go in, buy the dip, and to have these positions for longer. And I think that people were wrong when they doubted retail, because analysts were saying that they are irrational, they are chasing the hype, they are ignoring market risks. But so far we can say that just retail can be happy right now, and they earned this moment, so retail should enjoy it. But I think that the main question here is what will happen next, because retail is not underdog anymore. They are sitting on gains. So what will they do now? Is there really a long-term perspective behind it? Will they hold these positions? Are they going to cut them now as SP 500 and other indices are reaching the highs again? So I'm really wondering how they will decide next, and also what we will have to say on our next Retail Beat podcast.
Yeah, it'll be fascinating to know. It really will. I wonder the same things. It's like, if you manage to buy the dip and it's gone very well and we're back to positive for the year, not far off all-time highs, you've got a couple of things to think about. One is, okay, are we now overextended and this is a period where I take some profit, or all of it? Or am I a long-term investor and I've just bought the dip and I'm going to hold for a longer period anyway and whatever? So I think people need to understand their why, the reason that they got into that trade, their plan when they got into that trade, and stick to it. Obviously, if something crazy happens, like a pandemic or a massive crazy headline, then you change things, of course. But it's important to know why you got into those trades. I think if you were a short to medium term trader / investor, you know, when things look overextended, which they're not a million miles away from doing so now, place to maybe take some off the table. But I imagine a lot of people would have planned for that anyway. And if you've managed to get a few nice trades, a few good winners, and you take half that position off, look for cheaper alternatives elsewhere, it's been a great period. I mean, what would be completely not funny is if this is like a complete fake move to the upside, a fake blow off to the top, and then we go all the way lower again. And that'd be heartbreaking for a lot of people and really leave the market in a dire state. I don't think that's going to happen. And I think when we discussed the podcast, we were on retail investors' side. You know, we felt like historically 10%, 15% dips are bought up. You know, bear markets don't actually last that long now. The recoveries are a lot quicker. Maybe we didn't necessarily expect it to recover as quick as it did, but it has.
Yeah, we discussed so many times what is happening on the market. We were so negative about what will happen next. I remember every Monday was so negative, but rebounds were even faster. So I'm also wondering what will happen next. And maybe one other option of how retail might think is they will start moving their investments to other assets that have been underperforming in the recent months. So I think this is also one other options. Maybe they will look into small caps, something like that. But of course, it's all depends also on the future events and what we will see on the market. There are some things that we can expect and some others that we really cannot expect, some tweets or things like that. But is there anything that you are keeping your eye on the markets right now, like some events, something like that?
Yeah, I mean, listen, this year does feel like it's been the unscheduled events that have moved markets the most, and that's the comments throughout the day. That's the random Sunday night headlines that you can't expect, and then, like you said, on Monday it's just chaos, isn't it? It's the DeepSeek, it's the Trump tweets, it's the meme coins, it's the tariff deals, and then the fake news, the real news, and the sources you don't quite know if it's true or not news. And I imagine, unfortunately, that what's going to move the market most in the months to come is going to be similar kind of things. But we put a bit of a list together here, Neža, and we've got obviously tariff updates have got to be right up at the top there. We've got that 90-day period. What happens after that? That's going to be key. You might have seen, for those listening or watching at home or wherever you are, that Trump came out and said in many ways the EU are worse than China. So what's going to happen with the EU and US deal there? Obviously the UK have got a deal. I don't think there's much changed of it really. It's nothing to write home about, but it's not bad, so that's okay. We'll keep an eye on the Trump versus Powell situation. Are they going to lower rates? Are they going to keep rates on hold? That's obviously something to focus on. Recession watch as well was down, isn't it, last couple of days? And you'd imagine that will fluctuate based on everything we just talked about. And then, earnings season's coming to a close. And overall, I'd say it's been okay, to be honest, earnings season. And I guess once that finishes, you're looking towards the next one. But I don't know. I feel... If we had this conversation a week ago, I'd have said I feel positive about markets, and I did. But now when you get such a big reaction to the upside and everything is positive, you almost start to just take a step back, don't you? It's like when you said things are super negative, you think, well, it can't really get much worse now. There should be a relief rally. We've now had the relief rally, and it's kind of like, oh, what happens now? Do you know what I mean?
Yeah, we are... now that everything is much more positive, we started to look for things that could go wrong in the next few months, because there are things that could go wrong, and there always are. There are still some big earnings left. For example, we still have Nvidia reporting at the end of the month, and this is almost considered as a macro event. So this could be one of the events that could move the market. And of course, all of the tariff updates and all of the speeches, things like that, and all of the unpredictable stuff that we cannot even list today.
Yeah, it's going to be fascinating. It feels like one of the most interesting periods and interesting years in a long time. However, people are probably listening and watching this and say, Sam, you say that all the time. And I do, I'm guilty of it. But it does feel captivating, I feel, at the moment. But listen, we'll be here to discuss it all. And I hope you all enjoyed the episode. We'll wrap it up there. Neža, as always, thank you very much for joining.
Thank you, Sam. And see you next week, guys.